Ladies and gentlemen, imagine walking into an antique store and finding a rare painting with a price tag of just $50. Most people would walk right past it, not because they had carefully examined the painting, not because they knew who painted it, but because they assumed that if it were truly valuable, someone else would have already bought it. That simple instinct, the tendency to judge value by price, is one of the oldest mistakes in financial history. And tonight, I want to show you why that same mistake may be happening in one of the world's most misunderstood assets. Because silver has just delivered one of the strongest rallies of any major commodity. It has climbed dramatically from where it traded not long ago. Headlines called it a breakout. Analysts suddenly remembered it existed. Television panels began talking about precious metals again. And yet, if you ask many professional investors about silver today, they will still use exactly the same word. Cheap. Think about that for a moment. How can something become dramatically more expensive and still be considered inexpensive? Those two ideas sound impossible to hold at the same time, but they can. In fact, understanding why they may completely change the way you think about markets, not just silver. Because the biggest opportunities in financial history have rarely looked cheap on the surface. They looked confusing. They looked uncomfortable. They looked expensive to people staring only at yesterday's price, while quietly remaining undervalued to people looking at tomorrow's reality. And buried beneath today's silver market is one signal that almost nobody outside the largest institutions is paying attention to. It has nothing to do with social media excitement. Nothing to do with daily headlines. Nothing to do with internet predictions. It is quieter than all of that. But history suggests it matters far more. Stay with me. Because once you see the difference between price and value, you'll understand why some of the world's largest investors continue watching silver even after one of its biggest advances in years. Let us begin with something surprisingly simple. When most people say something is cheap, what do they actually mean? Usually, they mean the price is lower than it used to be. That is how our brains naturally work. If a television was once $2,000 and now sells for $900, we think it is cheap. If gasoline falls, it feels cheaper. If a stock falls 40%, people assume it must be a bargain. But markets rarely reward assumptions. Because price and value are two completely different things. Price is simply the number someone is willing to pay today. Value is what something may ultimately prove to be worth over time. Those are not always the same. Sometimes they move together. Sometimes they move in opposite directions. History is filled with moments when extraordinary businesses looked expensive before becoming much more valuable. And history is equally filled with assets that looked incredibly cheap, right before collapsing even further. The market constantly asks one question. What is today's mood? Successful investors ask a different one. What is actually changing underneath the surface? That difference sounds small. In reality, it separates speculation from investing. Think back to almost every major financial boom. During the technology revolution, people bought companies simply because everyone else was buying them. During housing booms, homes became can't-lose investments. During cryptocurrency surges, many buyers admitted they had no idea how blockchain worked. They only knew prices kept rising. Human psychology almost never changes. When prices rise, people become confident. When prices fall, they become fearful. Neither emotion tells us very much about value. They simply tell us how people feel. And feelings, no matter how powerful, can change remarkably fast. Markets have always reflected human emotion. Optimism, fear, greed, regret, hope, panic. Those emotions appear on price charts every single day. The challenge is that emotions often move much faster than reality itself. Which brings us back to silver. If someone only looked at recent headlines, they might conclude the story is already over. The rally already happened. I missed it. It's too late. Those statements sound logical. But notice something fascinating. They all depend entirely on looking backward. None of them ask what happens next. One of the greatest investors of all time once observed that the market behaves like a voting machine in the short run, but a weighing machine in the long run. That may be one of the most important ideas ever expressed about investing. Every day, millions of opinions vote. News votes. Television votes. Algorithms vote. Social media votes. Speculators vote. Momentum traders vote. Fear votes. Excitement votes. Prices respond instantly. But underneath all those daily votes, reality keeps quietly accumulating. Factories continue consuming raw materials. Governments continue making policy decisions. Mining companies continue extracting metal. Manufacturers continue placing orders. Technology continues evolving. Those things do not change every afternoon. They change slowly, almost invisibly, until suddenly, the market notices. By then, most of the move has already happened. This brings us to the first hidden signal beneath today's silver market. And strangely enough, it is not the silver price itself. Professional investors understand something that many new investors never consider. Sometimes, the most important information is not found in what an asset is doing. It is found in who continues needing it regardless of price. Think about electricity. Whether prices rise or fall, hospitals still need power. Data centers still need power. Airports still need power. Modern economies cannot simply decide to stop using electricity because prices changed. Certain materials function in much the same way. They are not purchased because someone hopes to make money tomorrow. They are purchased because entire industries cannot operate without them. That distinction matters enormously. Speculative demand can disappear overnight. Industrial necessity usually cannot. And that is where many experienced investors begin asking very different questions. Instead of asking, why did silver go up? They ask, who keeps buying even when nobody is talking about it? That question often leads somewhere much more interesting. Because while financial television spends enormous amounts of time discussing daily price movements, another story unfolds quietly in the background. Manufacturers sign contracts months in advance. Technology companies secure future supplies. Energy projects continue expanding. Medical equipment producers continue building devices. Engineers continue solving problems. None of those decisions are made because silver appeared in today's headlines. They are made because production schedules do not wait for market sentiment. That is a very different type of demand. It does not chase excitement. It exists because modern industry depends on reliability. And whenever investment demand begins growing on top of steady industrial demand, markets can begin behaving very differently from what casual observers expect. That does not guarantee higher prices tomorrow. Markets never make guarantees. But it changes the conversation entirely. Instead of asking, has silver already gone up? The better question becomes, what happens if demand keeps expanding while supply struggles to respond? That, ladies and gentlemen, is where our story truly begins. Because the deeper you look beneath today's silver market, the less this becomes a story about daily price charts. And the more it becomes a story about something quietly changing underneath the global economy itself. And once you see that hidden foundation, it becomes much easier to understand why some of the world's most experienced investors continue describing silver with a word that sounds completely impossible after such a powerful rally. Cheap. The real silver market, physical metal, industrial demand, paper trading, and why institutions are paying attention. Ladies and gentlemen, every market has a story that everyone sees. And then it has another story, the one unfolding quietly beneath the headlines. Silver is no different. Most people experience silver through a number flashing across a screen. One moment it's higher. The next moment it's lower. Financial media reports the change. Commentators explain the day's movement. Social media celebrates or panics. Then everyone waits for tomorrow's price. But imagine judging the health of an entire city by watching only its traffic lights. You would see movement, but you would miss everything that actually keeps the city alive. Factories, hospitals, warehouses, power stations, supply chains. The same idea applies to silver. The daily price is visible. The real story is often invisible. And that invisible story begins with a simple reality. Unlike many financial assets, silver is not valuable only because investors believe it is valuable. It performs jobs that few other materials can perform as effectively. That distinction changes everything. Consider what happens inside a modern economy. Every day, manufacturers build products that millions of people will never think twice about. Electric vehicles, communication systems, medical equipment, industrial electronics, renewable energy infrastructure, advanced computing hardware. These industries are competing with one another for efficiency, reliability, and performance. When engineers select materials, they usually are not asking which option is fashionable. They ask which option works. Silver has remained essential because its physical properties continue solving real engineering problems. Excellent electrical conductivity, exceptional thermal performance, high reliability in demanding environments. Those characteristics are the result of chemistry, not market sentiment. Whether investors are optimistic or pessimistic does not change the way electricity flows through silver. Physics ignores headlines. That is why industrial demand deserves far more attention than many casual investors realize. When industries expand over years rather than weeks, their material requirements can become remarkably persistent. They are responding to production schedules, infrastructure investments, and technological development, not daily market emotion. That creates an important difference between temporary enthusiasm and structural demand. Now imagine two entirely different buyers entering the silver market. The first is a trader. The second is a manufacturer. The trader hopes to profit from tomorrow's price movement. The manufacturer hopes to keep tomorrow's production line operating. Those are completely different motivations. If prices become volatile, traders may leave the market overnight. Factories usually cannot. Products still need to be built. Contracts still need to be fulfilled. Customers still expect deliveries. This is one reason experienced analysts spend considerable time studying industrial consumption alongside investment demand. They are trying to understand not only who wants silver today, but who may continue needing it regardless of changing market conditions. That question often proves more important than today's closing price. There is another layer to this story that many new investors find surprising. Not every ounce of silver exists in the same marketplace. On one side is physical silver, coins, bars, industrial inventories, metal that can actually be delivered, stored, transported, or manufactured into products. On the other side are financial contracts linked to silver. These contracts serve many legitimate purposes. Mining companies use them to manage risk. Manufacturers may use them to reduce uncertainty. Professional traders use them to provide liquidity. They are an important part of modern commodity markets. But it is also important to recognize that financial contracts and physical metal are not identical things. One represents ownership of metal. The other may represent an agreement connected to that metal under specific conditions. Most of the time, these systems function smoothly. Participants settle positions. Contracts expire. Markets continue operating. Yet periods of unusually strong physical demand sometimes attract special attention. Why? Because they remind investors that there is a meaningful distinction between trading exposure to silver and possessing actual metal. Whenever discussions shift from price alone toward physical availability, market psychology can begin changing. Suddenly the conversation is no longer only about charts. It becomes about supply chains, inventory, production, delivery. That represents a very different type of market analysis. Professional institutions understand this distinction extremely well. Contrary to popular belief, large financial organizations rarely make decisions based solely on a single price chart. They examine a much broader landscape: economic growth, manufacturing activity, monetary policy, industrial investment, global trade, commodity inventories, energy trends, capital flows. Each piece provides only part of the puzzle. Together, they help build a picture of where supply and demand may be heading over time. Notice something interesting. Institutions often become more interested when uncertainty increases. Not because uncertainty guarantees profits, but because uncertainty changes probabilities. Markets constantly move between periods of confidence and periods of caution. During those transitions, assets with multiple sources of demand sometimes receive closer examination. Silver occupies an unusual position because it participates in more than one world at the same time. It is an industrial material. It is a precious metal. It is part manufacturing input, part investment asset, part monetary history. Very few commodities occupy all those roles simultaneously. That complexity makes silver difficult to classify. It also makes it difficult to ignore. There is another reason experienced market observers continue monitoring silver carefully. Modern economies are becoming increasingly dependent on technologies requiring sophisticated electronic components. Whether discussing renewable energy infrastructure, automation, communications equipment, or advanced computing, the broader direction points toward greater technological intensity. Every technological transition creates winners, losers, and new resource requirements. History demonstrates this repeatedly. Railroads required steel. Automobiles transformed energy markets. The digital revolution increased demand for semiconductors. Artificial intelligence is accelerating investment in computing infrastructure across multiple regions. Whenever technological shifts occur, supply chains adapt. Manufacturing expands. Raw materials become strategically important. No single commodity determines the future by itself, but some become increasingly relevant as economies evolve. That is why long-term investors often spend less time predicting tomorrow's price, and more time identifying structural trends that may unfold over many years. This brings us back to the question we began with. Why are some investors still willing to describe silver as inexpensive despite its remarkable advance? Not necessarily because they expect immediate gains. Not because they believe markets only move upward. Markets never do. Rather, many are asking whether today's price fully reflects tomorrow's environment. That is a different question. It requires looking beyond this week's headlines, beyond today's volatility, beyond temporary optimism or pessimism. It requires examining the forces quietly reshaping manufacturing, technology, investment behavior, and resource demand around the world. Those forces rarely announce themselves dramatically. They build gradually, almost silently, until one day, the market begins paying attention all at once. And history suggests that when markets finally recognize long-developing structural changes, the adjustment can happen far more quickly than most people expect. Which leads us to the final and perhaps most important chapter of our story. Because every opportunity carries uncertainty, every investment involves risk, and every period of optimism deserves to be tested against history. So before drawing any conclusions, we need to examine what previous market cycles can teach us, what could still go wrong, and why the next chapter of silver's story may depend less on excitement and more on patience. Point 3: Possible futures, the biggest risk, lessons from history, and why patience often outperforms prediction. Ladies and gentlemen, every investment story eventually reaches the same moment. The moment when certainty disappears. Numbers can explain the past. Charts can record what has already happened. But the future belongs to probabilities. No analyst, no economist, and no institution can tell you exactly where silver will trade 6 months from now. Markets are simply too complex. New technologies emerge. Governments change policy. Central banks adjust interest rates. Geopolitical events reshape supply chains overnight. One unexpected headline can overwhelm months of careful forecasting. That uncertainty isn't a flaw in markets. It is the price of participating in them. The important question is not whether anyone can predict tomorrow perfectly. The important question is whether investors are preparing for multiple possible outcomes instead of betting everything on one. Let's consider 3 futures that could unfold over the next several years. Scenario 1, the slow repricing. This is perhaps the least dramatic outcome. Economic growth continues, but at a moderate pace. Industrial demand remains healthy. Mining supply gradually improves, though not enough to dramatically change the balance. Interest rates slowly normalize as inflation pressures ease. In this environment, silver may not experience explosive moves. Instead, prices could climb gradually as supply and demand become more balanced. This type of market rarely creates sensational headlines. Instead, it rewards patience. History shows that some of the strongest long-term investments have advanced quietly for years while attracting very little public attention. By the time the headlines finally appeared, much of the move had already occurred. Scenario 2, industrial acceleration. Now imagine something different. Investment in advanced manufacturing increases faster than expected. Artificial intelligence drives another wave of data center construction. Power infrastructure expands. Electric transportation continues growing. Renewable energy projects accelerate across multiple regions. Under this scenario, industrial demand strengthens beyond current expectations. Manufacturers compete more aggressively for essential materials. Inventories become increasingly valuable. Investors begin recognizing that silver is participating in multiple growth stories simultaneously. Not because of speculation, but because modern economies require materials capable of supporting increasingly sophisticated technologies. Markets often respond quickly once they recognize a structural trend. Not gradually. Suddenly. Scenario 3, the unexpected shock. History reminds us that markets rarely move in straight lines. Unexpected events occur. Financial stress appears where few people were looking. Political tensions affect trade. Supply chains become disrupted. Confidence changes rapidly. During periods like these, investors often reconsider where they store wealth and how they diversify risk. Sometimes that benefits precious metals. Sometimes it does not. Every crisis is different. The lesson is not that history repeats exactly. The lesson is that resilience becomes valuable during uncertainty. Assets viewed one way during stable periods may be viewed very differently when conditions change. That is why experienced investors rarely build portfolios designed for only one possible future. They prepare for several, but every discussion about opportunity must also include risk. Silver is not a guaranteed path to success. It never has been. Its history includes extraordinary rallies. It also includes painful declines. Volatility is part of its identity. Investors attracted only by the possibility of rapid gains often discover that rapid declines are part of the same market. Patience is easier to admire than to practice. Many people become enthusiastic after prices rise. Few remain disciplined when markets become uncomfortable. That is one reason successful investing often feels emotionally difficult. It asks people to remain rational while everyone else is becoming emotional. History offers a valuable perspective. During different decades, markets have repeatedly underestimated assets connected to long-term economic transitions. Railroads, electricity, oil, telecommunications, computing. Each transformation created periods of skepticism alongside periods of extraordinary optimism. Very few participants correctly identified every turning point. But many successful investors shared one habit. They focused less on predicting next month's price and more on understanding long-term structural change. That mindset remains valuable today, whether discussing silver, energy, technology, or any other asset class. The question is always similar. What is changing beneath the surface that today's headlines may not fully reflect? Perhaps that is the greatest lesson this market offers. Financial markets constantly encourage urgency. Breaking news, minute-by-minute updates, daily predictions, endless opinions. Yet genuine long-term wealth has often been built by people who spent more time understanding businesses, industries, and economic trends than reacting to every headline. Information is abundant. Perspective is rare. And perspective often becomes the greatest competitive advantage an investor can possess. So where does that leave us? We began this journey with a contradiction. Silver had already risen significantly, yet many experienced investors continued describing it as relatively inexpensive. By now, that contradiction should make more sense. Price alone tells only part of the story. Value depends on the broader environment surrounding that price. Industrial demand, technological change, supply dynamics, monetary policy, global investment behavior. These forces interact continuously. Sometimes they reinforce one another. Sometimes they move in opposite directions. Understanding those relationships is far more useful than reacting to any single day's movement. If there is one idea worth remembering after today's discussion, it is this. Markets constantly fluctuate. Fundamentals usually evolve much more slowly. Learning to distinguish between temporary noise and meaningful structural change may be one of the most valuable skills any investor can develop. That doesn't guarantee success. Nothing can. But it encourages decisions based on analysis rather than emotion. And history suggests that discipline often outlasts excitement. Before we finish, I'd genuinely like to hear your perspective. Do you believe silver's recent performance reflects temporary enthusiasm? Or do you think larger economic changes are beginning to reshape its role in the global economy? Share your thoughts in the comments. Some of the most thoughtful discussions come from viewers who bring different experiences and challenge conventional thinking. If you found this analysis valuable, consider subscribing. Each week, we examine the forces shaping global markets, not to predict the future with certainty, but to better understand the probabilities that investors face. Because informed decisions rarely begin with bold predictions. They begin with better questions. And in investing, the quality of your questions often determines the quality of your decisions. Thank you for watching.